You ever tried to open an investment account and thought, why are there so many forms? Why do they need to know everything about me? Well, today we're going to walk through the account opening process step by step, especially how it works for institutional clients like companies, municipalities, and large organizations. By the end of this video, you'll know exactly what happens behind the scenes, what documents you'll be asked for, and how to avoid the most common delays. I'm James Barry from the Cash Management Group, and for over a decade, I've been helping financial institutions gain the upper hand. Today's topic is the account opening process, especially for institutional accounts. Think school boards, cities, trusts, corporations, all the big clients. Let's start with a basic question. What is an account? An account is basically a container where your money and investments are kept, tracked, and reported. For an institutional client, that container is usually held at a custodian or bank and managed by an investment manager or advisor. You can think of it like this. The custodian is the vault and the record keeper. The manager is the driver who decides where that money goes, based, of course, on the client's rules. Before anyone can start investing, that container needs to be opened properly. And that's where the account opening process comes in. Step one is usually a discovery conversation. For institutional clients, it's not just what's your name and what's your risk tolerance. It's more like, who are you as an organization? What is this money for? And how long would you want it to be invested? What rules do you have to follow? For example, a city or school might have strict rules set by bylaws or laws or by policy. And from that, the manager builds and follows an investment policy. You can think of the investment policy like a rule book. What can you invest in? What can you not invest in? How much risk is okay? And what are the performance goals? This step sets the direction. The paperwork comes later and is for making this official. Next is what everyone loves to hate, forms and documents. For an institutional account, the firm usually needs basic information about the entity, the legal name, address, and the type of entity. For example, a corporation, a municipality, a trust, or a charity. They will need proof the entity exists and is in good standing, like articles of incorporation, a trust deed, or bylaws and resolutions. They also need to know who are the authorized signers, who, effectively, is allowed to sign on behalf of that entity, who can give those trading instructions, and who can access the statements. On top of that, there are compliance documents, like account application forms, agreements that explain fees and responsibilities and how the account will be managed. And there are disclosures about risk and how data is used. Now we get into three big acronyms you are going to hear a lot: KYC, AML, and beneficial owner. KYC stands for Know Your Client. It's a process where the firm learns who you are, what your financial situation looks like, and whether the type of investing you want is suitable for you. AML stands for anti-money laundering. This is about making sure the money comes from legal sources and that the account is not being used to hide or move illegal funds. For institutions, there's another key idea: beneficial owners. These are people who ultimately benefit from the money. For a company, it might be large shareholders. For a charity, it might be the community it serves. Regulators want firms to know who's really behind the account, not just the person signing the documents. That's why you'll see requests for ID for key people, ownership charts, and extra questions if the client is connected to government or politics. This is not being nosy, it is to follow the law, protect the system, and keep both the client and the firm safe. After the forms are filled out and documents are collected, the file goes into an internal review. This usually means operation teams check out everything is complete and accurate. The compliance team makes sure that all the regulations are being followed. And even sometimes, the legal team steps in if there's something unusual about the structure. If something is missing, like a signature, resolution, or proof of address, the file comes back, which is what creates delays. Once everything is approved, the account is created in the system, it's assigned an account number, and the client is set up for online access and reporting. At this point, the container is officially open, but it's still empty. Now, we go to the fun part, funding the account. For institutions, money usually comes in through wire transfers, electronic fund transfers, or sometimes moving assets from another custodian. The firm will give very specific wire instructions: the bank name, transit and account numbers, and reference details, so they know which client the money belongs to. Once the cash arrives and is matched to the account, the manager can start investing according to the investment policy. That might mean buying short-term instruments for liquidity, building a ladder of bonds, or whatever strategy was agreed to in the discovery phase. From the client's point of view, this is the moment when we've signed a lot of papers. Finally turns into our money is actually working. Even after the account is opened, the process doesn't stop. There's ongoing monitoring of investments, there's reporting, monthly, quarterly, and annually, and updates if your organization changes, new signers, new addresses, mergers, or new rules. Sometimes regulators also require periodic refreshes of KYC information. So you might get asked again, can you confirm these details? It's not because someone has lost your file, it's because the rules say information has to stay up to date. So that's the account opening process in a nutshell. Discovery and understanding the client, paperwork and entity documents, KYC, AML, and beneficial owners. There's an internal review and approval, finally funding the account and placing the first trades, and afterwards, ongoing updates and reporting. If you are an institutional investor, the key to a smooth experience is simple. Be ready with your documents, know who can sign, and respond quickly when the operations or compliance teams have questions. If you want more videos breaking down how institutional finance works, hit the like button, subscribe, and let me know in the comments what part of the process you want me to cover next. Thanks for watching, and I'll see you in the next one.